Well, U.S. natural gas futures eased to a 7-week low on Friday on forecasts for milder weather and lower demand over the next 2 weeks than previously expected and near record output. That kept the front month back in technically oversold territory for a second day in a row. For the week, the contract was down about 3% after dropping around 22% last week. Looking forward, the market is showing signs that traders are not worried about having enough gas supplies in storage for the winter. The premium of futures for March over April 2026 was trading at a record low of around 2 cents. The industry calls the March-April spread the widowmaker because rapid price moves resulting from changing weather forecasts have forced some speculators out of business, including the Amaranth hedge fund, which lost more than $6 billion in 2006. Traders used the March, April and October-November spreads to bet on winter weather forecasts and supply and demand. March is the last month of the winter heating season when utilities pull gas out of storage, and October is the last month of the summer cooling season when utilities inject gas into storage. At the same time, gas futures for calendar 2026 fell to a 13-month low of $3.73. That compares with a futures average of $3.60 so far in 2025, $2.41 in 2024, and $3.52 over the prior 5 years. Meanwhile, average gas output in the lower 48 states held at 109.6 billion cubic feet per day so far in December, the same as November's monthly record high. Meteorologists forecast weather across the country would remain mostly warmer than normal through January 3, keeping the amount of gas needed to heat homes and businesses lower than usual for this time of year. Meanwhile, projected average gas demand in the lower 48 states, including exports, would fall from 144.6 billion cubic feet per day this week to 127.5 over the next 2 weeks. The forecast for next week was lower than the outlook on Thursday. Meanwhile, as U.S. natural gas prices retreated, LNG shipments showed signs of slowing. A total of 33 LNG vessels, carrying roughly 126 billion cubic feet, departed U.S. ports between December 11 and December 17. From a technical perspective, near-term support sits in the $3.70 to $3.90 area. As long as this zone holds, prices may consolidate or see brief short covering bounces. However, if prices clearly break below this support level, the market could move lower toward the $3.50 area. On the upside, resistance is clustered near $4, where previous rebounds have stalled. Bulls would need a sustained move above that zone to shift the short-term bias. For the coming week, the most likely scenario is range-bound to slightly bearish trading, with rallies expected to be sold unless weather models turn decisively colder. Any upside moves are likely corrective rather than trend-changing. Overall, the market remains in sell-the-rally mode, with downside risks still outweighing upside potential unless a clear weather catalyst emerges. If you enjoyed the video, drop a comment, hit like and consider supporting the channel. It really helps keep things moving, and see you next time.